Nigeria's National Bureau of Statistics says non-performing loans in Nigeria's banking sector was at 10.8% in the first quarter of the year. Muyiwa Oni, Regional Head of Equity Research at Standard Bank Group, joins me for this discussion today. Thank you so much for joining me on the show today.
Thank you for having me, Kenneth.
So we're seeing that the CBN governor also mentioned the fact, when you listen to the statistics, that the NPLs kind of moderated a bit. You know, when you look at, as we're about to round up the second quarter of the year, I'd like you to give your assessment of the banking sector.
So I guess there are few positive numbers, if you look at it at the headlines, that show some improvement in the sector at some level. So if you look at asset quality, NPL ratio appears to be reducing. And so even though I think the question is really what the impact of restructured loans would be. And so if you consider the state and size of restructured loans, how does that color the asset quality position of banks? And I guess the bigger question as well is credit growth and how banks are able to deal with that. So even though for this year, you're still seeing banks forecast positive credit growth, but I guess the question is really how banks are able to achieve that. So I think guidance is between 5 to 10%. We think 5% appears more achievable. I think the bigger question is really more the tight liquidity environment. So as long as monetary policy remains tight, it's difficult to see how banks will be able to push credit growth. So even though the central bank continues to introduce schemes to provide low
we'll get to some
rate credit as well, but I guess that seems to be
we'll get to some of those initiatives in a bit, but I'd just like you to speak to the fact, because I read a report earlier by Fitch Ratings talking about the fact that the recent when they analyzed the full year numbers from the banks and looking at the IFRS 9 reporting standard, it shows that the asset quality for banks are still kind of weak.
So I get particularly when you look at the stage 3 loans. So there are a few banks like Zenith Bank, for example. If you factor in its stage 3 loans and compare that to its NPL ratio, so stage 3 ratio looks closer to about 10% versus an NPL ratio that is below 5%. So I guess that's more that's really what IFRS 9 exposes. And I think also if you consider that the central bank at some point, so even though early last year the expectations was that the capital charge on IFRS 9 will be applied just 1 year and be done just once, by the end of the year the central bank allowed some forbearance and allowed banks spread that over 4 years. And if you consider banks, so there are a few banks like First Bank, if they had to take that charge at all at once, you'd see some deficiency in capital adequacy ratio relative to the regulatory limit. So I suppose all that and implementation of that clearly still exposes some fragility in the sector.
All right, but I'll take you back to some of the comment made by the CBN governor during the MPC meeting, talking about the fact that the MPC is urging the CBN to look at they're looking at the legal or regulatory framework, to try and speed up the recovery of some of these bad loans. When you look at that, what shape? I'm trying to imagine the conversations that will happen in there, and what shape do you see that taking?
I think it's still a struggle, and I think for me, why I am still trying to figure out what kind of approach and how the central bank is able to achieve that is if you look at AMCON and also see numbers showing how AMCON is still dealing with challenge loans. So it's difficult to see how or which new regulatory measure would help to improve that position. And I suppose that's why ultimately for banks, they have to still be the first line and be seen as first line of defense in terms of dealing with asset quality. And so they ideally should do their credit checks. And I suppose that's also why you're seeing credit growth as weak as it is right now, more because the banks themselves are still quite cautious with extending credit. When you interact with banks, most banks are more comfortable with staying at the top end of the credit curve and not necessarily going down more because of the risk and the potential loan loss provisions that could come out from extending loans to such segments.
All right, but you still see the oil and gas sector still coming up tops when you look at the NPLs in there. We're seeing general commerce and manufacturing, power and energy. and ICT coming in that list there, some of the top ones. You know, but when you look at this, you know, how best can you encourage, do you think they can encourage banks to lend more to the real sector of the economy?
So I suppose one where you could start could be on interest rate. So if the interest rate environment is much more loose, so if monetary policy rate, for example, is lower than current rate of 13.5, that should have a more positive reflection on how banks can lend on rates as well. And then also on monetary tightening as well, if on the CRR, on cash reserve ratio, there's some element of looseness in that as well. So currently, officially, cash reserve ratio is about 22.5%, but when you engage with banks, it's closer to 30% and over for some. So if you're able, if such liquidity is freed up, then it's easy to see how there's more liquidity in the system. If rates decline considerably, banks can, in chase of yield, start looking to lend again. Right. But I guess there's also so you can argue that maybe that's the supply side. On the demand side, it's still a function of the state of the economy. So if banks struggle with viable options, then I guess that's also a challenge as well. And that, you'd argue, would be more a fiscal position. And so if we see more reforms that could help with dealing with our infrastructure challenges,
yeah, because a lot has been said about how challenging the operating environment is. Because I read a lot of this research, and then you see one of the key things they talk about when you talk about the Nigerian banking sector, it's how it is. But looking at, we're just about to round up Q2, I'd like to get your forward guidance into what you think the environment will look like going forward. Are you seeing any kind of reforms in there? Or are we going to see the new things coming from the banking sector? We're seeing more payment service banks and more or less coming into the fore.
So on payment service bank, there's clearly been questions around that and how that could disrupt this sector and segment. Even though when you engage with some of the telcos looking at that space, they would argue that for now they are not necessarily looking to take up the launch of the banks, and their focus is more on the excluded. So looking at individuals that are not necessarily in that segment right now, individuals open and willing to transfer small amounts of funds, 1,000 to 2,000 naira. So for now, you'd argue that it clearly does help to formalize that segment for financial inclusion. And I guess it's more how and the kind of competition it creates when you're talking about payment. So if it's easier and cheaper for me to pay my bills through one of my telcos than paying through my banks, then I might use that option, or it's easier to transfer as well. So I guess the challenge could come on the fee side, and banks clearly would have to figure out a way of defending their share from that point.
All right, then we'll keep our eyes and see how that plays out. Thank you so much for joining me on the show. I've been speaking to Muyiwa Oni. He's the Regional Head of Equity Research at Standard Bank Group.